to welcome back Bill Alderman, president of Alderman and Company. If you're unfamiliar, they are a leading aerospace M&A firm. And Bill, thanks for joining us again today. And Bill's going to be talking about mergers and acquisitions. Obviously, a very hot topic, or Bill, maybe I should say it's a cool topic right now. Why don't I hand it over to you to find out?
Thanks, Brian. So yeah, and Brian is referencing the fact that he knows a little bit about what I'm going to say. We talked about this a couple of days ago about the fact that parts of the world that we live in, the M&A activity is very low at the moment, if not ceased, zero activity in some niches. So let's jump into this. Brian, if I remember correctly, I've got a half hour. Is that correct, sir?
Yep, that sounds about right. Yep.
All right, and I'll try to get us back on time if we can, but if I steal some of my time back, please don't.
That's fine. We'll shift it around.
So I'm going to push buttons here and try and pull up slides. By going to full screen. This is a PDF actually at the moment. Brian, you have any recommendations whether we go like this or I try and do full screen?
I think that's fine just how it is.
All right, so let's try and go with this, people. Some of the slides are going to be a little bit eye chart-ish, and so I may zoom around and zoom in, but for the most part, they should be readable. So we'll jump right into it. The way I've laid this out is pre-pandemic last year, and again, this year, that year. Basically 2019, right? The pandemic began in, depending on where you live, February and March, depending on what part of the world you're in. And we'll talk about pre-pandemic, talk about 2020, which does include a number of months pre-pandemic, right? Just so we get all the math correct. And we'll talk about right now what we're seeing real time, and I'll give you a little bit of my forecast for the future. Real quick, not to bore you, just to give you a foundation of where I come from so you understand how my mind works. I started this firm in 2001. We are exclusively investment bankers doing sell-side M&A in aerospace and defense. That's all we've ever done for 21 years. We do a lot of things around that, but that's all we do. And we're licensed and regulated by FINRA and the SIPC. My bio, Brian, are people going to get copies of these slides when this is over?
If you'd like to share them.
Yeah, let's do that. That way I don't need to read my bio and bore people. I have a bio and I've been doing this a long time, and I have two partners that are smarter and more knowledgeable than me, Bruce Andrews and Kevin Gould. Their bios are up here too, but Bruce used to be the president of United Nuclear Corporation's division in Connecticut, and also was at Lycoming. And Kevin Gould started at Boeing and moved on to Bendix division of Honeywell and Piper Aircraft, where he was the CEO. And they're both highly educated, really good, smart, nice guys. Okay, and there's a sample of some deals we've done because we've done some deals because we're bankers. And this is relevant for a second here, where we operate. So you guys understand when I talk about the market, my market, your market, because everybody's a little different. So if we start in the top right, commercial aviation is about 36% of our world. Defense is 46%, the balance is biz aviation. 81% is US, 19% is outside the US. We don't actually look for clients outside the US, but we get taken there sometimes. And in terms of what our clients do, 44% are manufacturers, 32% are service, 15% distribution, and sort of 9% are sort of other. And by services, the bulk of that would be MRO, for those who speak jargon, maintenance, repair, and overhaul, sustainment if you're a defense person, okay? All right, so that's enough about me, but I just want you to understand where I come from and what I do and how I sort of get my brain wrapped around this stuff. So data points for you people, because most people on this call are deep in the industry or serve the industry. And we're data junkies, and we live based on facts. As I like to say, and I'm a pilot, my aircraft doesn't rotate because I want it to or because it has nice political views. It rotates because it hits V1, and that's what the book says. And guess what? That's when it rotates. So this is going to be rich on data, a little bit of prognostication and subjective nonsense from me, but I'm going to try and keep this based on the data because that's what I think you guys want. So in the world of under $100 million in revenue, and that's where we focus when we say middle market. So revenues are under $100 million. Now, this is pre-COVID, okay? Everything changes in COVID. But our clientele and the data we do are companies that normally have under 100 million in revenue, majority commercial aviation supply chain, and sale of 100% of the business. So these are deals that were done over the past 3 years. 25 deals in that exact niche were done in 18, 20 in 19, and 6 in 2020. And the 6 that were in 2020, some of them were done before the pandemic hit, and a couple were weird. So basically the market seized up, or you can say it's down 80% or 90% or however you want to run the math. To me, the market seized, right? And I'm a broker. I want buyers and sellers happy, right? I'm relatively agnostic to whether my clients are getting a huge price or a low price. I mean, I want them to do really well, but if they're happy, they're happy. Whether I like it or not, they're happy. And deals get done when buyers and sellers are happy with the transaction. Whether it's high or low, they're both happy and you get deals done. The market seizes when the buyers and sellers can't agree on price. Well, guess what happened during the pandemic? Everybody knew values dropped. The issue is that the buyers thought values dropped a lot, and the sellers thought they didn't drop a lot. And so the market seized because they couldn't agree on price. All right, so where's this come from, right? So why did the market seize? And some of this is just pure, simple common sense, but some of it is also deep in the data. So the airlines drive M&A activity in commercial aviation. Been doing this for 20 years on my own. I've been doing this for 30 years in total. That's where it comes from. Okay, our customers have customers who have customers who have customers. At some point, a human being or a box is paying to be on an airplane. That's where it starts. And if people don't get on airplanes, then everybody downstream suffers. And that's what drives the M&A activity. Now, if everybody was suffering, but all the buyers and sellers had the same view, the market wouldn't have seized. The issue is with an exogenous shock like this and so much uncertainty, buyers are going to be more pessimistic than sellers. And so they can't agree. Sellers like, we'll get through this. It'll be fine. And buyers like, well, maybe you won't. I actually, maybe you're both right. As a broker, what I really care about is you guys can just get along, right? When you guys are fighting with each other, then I'm not happy. And that's what's going on right now, is that the buyers and sellers can't reach an agreement on value because no one really knows how bad this is going to be and for how long. And if you just look at the IATA numbers, these are from IATA 2 days ago, the red bars show the forecast for industry-wide losses that they published in December, right? And the exact number is right around $40 billion losses, okay? Which is a great improvement from last year, right? Last year, it was $130 billion in losses, okay? So it's a wonderful improvement, but just in 3 months, IATA's changed the number by $7 billion. That kind of uncertainty is why buyers and sellers can't agree. You can't have these numbers moving like that every 3 months. It drives buyers and sellers crazy, especially the buyers right now. Airline profits are driven by traffic. So the traffic's bouncing around. Forecasts for profits are bouncing around. Right now, the current thinking out of IATA as of 2 days ago is that industry-wide, this is the globe, all the airlines, they'll be down about 55% from pre-COVID. Okay, but I guarantee you that number is going to change in 3 days. And that's what's driving this market to be seized up. Okay, there's another thing that currently is driving this market. And, I've been doing this 30 years. It's not often that I see this kind of stuff driving the M&A activity in the commercial aviation industry. Okay, and it's not, the concept is not for just commercial aviation, it's for any industry. But federal intervention can mess with things, okay? Depends on what it is. Tax rates can cause a little bit of a hiccup. Interest rates can cause a little bit of a hiccup. But this stuff here was huge. And let me just talk about the CARES Act for a second. Without going into politics, economically speaking, the CARES Act has been wonderful for the commercial aviation supply chain. Right? Section 1102, and I want to be a little data specific here rather than vague. Section 1102 is the Paycheck Protection Program. Draw 1 was for 500 and fewer employees. Draw 2 was for 300 and fewer employees. And a lot of people are not focusing or didn't focus on Section 4013. Right? If you actually, right, it's U.S. law. You can print it off the internet and read it, right? And so we have. Section 4013 is temporary relief from troubled debt. Now, why do I care? Well, that's what banks are required to do to be in compliance with the laws and rules of the Office of the Controller of the Currency about what banks have to do from a regulatory perspective regarding loans that are in default. In the old days, when you defaulted on a loan, the bank had to classify it as that, and that changed their accounting rules or requirements. They had to report that as a potential loan loss, and they had to have a change in their capital reserves to meet it. Remember when banks used to go bust and there was a real estate bubble and this bubble? When banks have bad loans, their capital gets constrained, and the Federal Reserve sort of hunkers down on them, and they have to shift some capital around, and it causes them to lose money. It causes them to have to raise more equity. It's harmful to the banks to have a lot of losses, and the Federal Reserve and the Office of Controller of Currency and the Treasury monitors all this stuff. Okay, well, Section 4013 basically said to the banks, you don't have any more issues with defaulted loans. Any troubled loan, don't worry about. No accounting losses, no loan loss reserves, no capital requirements. Just don't worry about it. Now, I'm broad brushing this, but that's what it says. You can read that. Okay. So money went to the supply chain, and the banks that lent to these people said, yeah, if they can't pay you back, don't worry about it. Okay. So what did that do to M&A activity? Well, it didn't drive prices up. But what it did was it normally, when a market is suffering, there are some bankruptcies, and that leads to M&A activity because it's called a forced sale, right? You're not selling your company because you wanted to, you're selling it because your creditors are making you do it to pay them back. Okay? With 30% fewer bankruptcies last year than 2019. Think about that. 2019 was one of the strongest economic years in our lifetime in the United States of America. And the United States of America, during the pandemic, which is potentially one of the most devastating things to happen to us since World War II, 30% reduction in bankruptcies. That makes no sense. Well, it's legislative, right? The federal government caused this, which was great for the supply chain. Lousy for M&A activity, because there should have been a lot of distressed sales last year, but there were none. Tech, which hit the wires a week ago, is the first. Okay. So what are we seeing in the market right now? And right now, the market is bifurcated. And this is a similar chart to the one we put up at the PNAA a month ago, roughly. But we've changed some of the words. It's the same graphic, same bifurcated, but things are moving around a little bit. So let me give you the update. Now, the aftermarket supply chain, right? And you all know what I mean by the aftermarket, right? It's MRO. It's all the things that are not new production. If you manufacture new parts for Boeing, but you also manufacture spares, we consider that spares production to be aftermarket, okay? So the supply chain for the aftermarket is warming in terms of M&A activity. Buyers are starting to price growth. That means that you had a loss 4 months ago. You were break even 3 months ago. This month, you're going to make a little profit. Buyers are literally willing to pay you cash today based on some reasonable level of growth tomorrow, because the market's going to recover. It is recovering. Right? Values, therefore, are recovering. The sellers are slowly returning to the market. Now, what do we mean by that? We mean that we are participating in sellers and buyers opening dialogues. It was for the past year, hey, Bill, we want to buy one of your clients. Can you? Nope. My clients told me I can't. They don't want to talk to you. Hey, Bill, we don't want to sell today, but we'd like to sell in 2 years. Fine. Now those people are saying, hey, Bill, let's go have dinner at the MRO show with so-and-so. We're all going to be there. It's the first time we've traveled in 14 months. Let's go talk to these people. Not doing a deal. Let's go talk. That has started in the past 45 days. We expect to see deals announced in the fourth quarter. Actual M&A activity will be announced, we think, in the fourth quarter. OEM supply chain, different animal. Tale of two cities, as a famous author once wrote. The market is completely frozen. There's a ton of money looking for acquisitions. Call them distressed buyers. They're not distressed. They're buyers looking for distressed deals. They're actively looking, and they have billions of dollars of capital at their fingertips. And I mean billions. Okay. For example, Warburg Pincus just announced that they were getting together with Al Wood, who came out of Boeing, and they're putting huge money behind him. That's in aircraft leasing. It's a unique niche. It's not in the supply chain of OEM directly, but I say it just because it's a huge bucket of money that just got allocated to look for buying opportunities. There are no willing sellers right now in the OEM supply chain. None. We expect to see a lot of forced sales starting in Q4. So all the things I wrote about in the previous slide about federal legislation that prevented forced sales, we believe that's going to stop all of that federal momentum. PPP is running out. We believe that the Section 4013 will be rescinded soon, and the banks will be allowed to move against distressed assets. Okay. A little bit of an eye chart. Maybe not. Maybe the colors are good enough. And Brian, I'll look to you to tell me, blow it up if I need to. But we do surveys all the time. And this is a survey we did, I think this was the 6th through the 12th of April. So it's now 9 days old. And we reached out specifically just to private equity firms, about 500 of them. Not all of them responded, but we reached out to about 500 firms. And this is the data that we got. And you'll see it's just Q4, Q2, those are the question numbers, not the quarter of the year. I'm not, Q5 is maybe high on my list for a financial report, but that's not a typo. These are just the question numbers. And we've got I didn't want to put the whole survey up. But we asked these firms what they're seeing and what they're thinking about making acquisitions prospectively in commercial aviation or in aviation in the year ahead. So the first question was, what size deals are you looking for? And most of the firms are looking for smaller deals. And we asked some really big firms. In our sample were firms from 40 billion dollars in assets under management to small firms. But what's interesting is that top green bar, it says less than $5 million, if you can see that. That's the EBITDA number, okay? And then the middle blue is 5 to 10, and the yellow orange is above 10. So the market is looking for small deals, okay? Or at least companies that now have a small amount of EBITDA, because TTM means trailing. So if you add less than 5 million of EBITDA during 2020, you're a hot target for private equity. Go to question number 4. What segment of A&D? And these are only folks that are looking to invest in A&D as a start. And then we narrowed down and said, of the 4 sectors, where are you looking most aggressively? And you'll see that defense is the yellow-orange, is almost 40, I think it's 43%. But more than that was commercial aviation, okay? And then you got a little bit of business aviation and a little bit of urban air mobility, okay? But heavily, these guys are looking at commercial aviation. And then the 2 subsegments, interestingly, they're looking at the aftermarket first. That makes sense. It's coming back first. And in terms of the question, which was most important to us, why is M&A activity so low at the moment? And the reasons are, and I'll read them to you. The number one reason is that sellers are waiting. The number 2 reason is the PPP and the CARES Act. And then you had buyers and sellers are not agreeing on price. Sellers are not willing to accept earnouts, and you can't read these, just sort of typed out. And sellers don't value the amount of earnout being granted. By and far, the expectation amongst private equity right now is the sellers that can wait are waiting. Okay.
Hey, Bill, we got a question from Gerardo on your previous slide, and that is, you're talking about PPP and whatnot. So what's the best approach to allow laissez-faire and have the open market do their jobs or be a government incentive or intervene, attacks the payers. I'm sorry, syntax is off there a little bit, but I think I know what you're getting at.
All right, so help me out, Brian, a little bit. I'm on slide 10. That's where you want me to be, right?
I think that's where you want to be. Yep.
All
So
right.
I think the question is it better for these companies to hunker down and do their thing, or is it better that the government helps support them?
So I firmly believe from a socio-economic perspective that the $2.2 trillion that President Trump approved was the perfect decision by our federal government. Keep people fed, keep them housed during this incredible event, and then let the market disruption take place afterwards. So I think it was a great move. I believe now enough people can feed themselves. The economy is recovering. It's now time to let the market be disrupted normally, and supply and demand. Right? We are capitalists in this country and in much of the free world. We don't believe that government should tell people what they should buy and sell. We believe we have a better mousetrap than that, and it's called the free markets. And let people decide what they should buy, what they should make, what they should sell, and what should be in demand and what shouldn't be. I believe that. I'm a capitalist. Okay. So I believe that aside from 1 in 100-year events where people will starve to death if the government doesn't intervene, I think the free market should be let to do its thing. And I think this market will do its thing. And when it does this thing, it will get disrupted and it will be difficult. And there will be bankruptcies, which I'll flip to. By the way, sorry about the previous slide. This slide's larger, which you can maybe see a little bit better. And I apologize for the previous one. But it's the same data. It's just this one's easier to read. Okay. So I'm going to do my prognostication, and then I think after this slide, I've got a little bit of examples about some multiples, and then I'm done and happy to answer all the questions. So the forecast is this. The M&A activity in the aftermarket will start to increase. Willing sellers in the aftermarket will be coming back. Discussions will be starting soon. I actually am involved in, and some very preliminary discussions have already started. I think deal announcements will take place Q4. I could be off by 2 months. Buyers will pay for value based on a reasonable rate of recovery. Buyers will pay for, yep, we think you're going to recover in the aftermarket. Offers will approach but not reach pre-pandemic levels. Owners who wanted to exit in 2020, for example, you wanted to retire. Your plan was always to retire when you turned 68, and you turned 68 in February of 2020. Whoops. But that individual will be able to exit sometime, I think, if not Q4 of this year, Q1 of next year. And EBITDA multiples will look odd. I'm going to table that, and we'll do it on the next slide. I've got bad news for people in new production. And I think Brian's getting to know my style well enough. I sort of call it the way I see it. I may not always see it right, but I just call it like I see it. And what I see is there'll be a lot of M&A activity in the OEM, new production supply chain, but they will all be unwilling sellers. They'll be forced sales, principally Chapter 11, Section 363. Most of the buyers will be very sophisticated with a lot of cash on hand. Values are going to decline, and they're going to keep declining until they become deeply discounted. Right now, there's no benchmark. There is no value. Tech just went bankrupt. We don't know what it's going to sell for. Could it sell for 30% less than it was worth 2 years ago? Could it be 40%? Could it be 50%? Could it be 10%? I don't know yet. No one knows yet, but it's going to decline. I think tech's going to do better than the next one, which will do better than the next one until we hit a bottom. But as the market starts to disrupt, it'll be worse to be disrupted later, if that makes sense. Then it will recover. And some will convert to 7, right? Chapter 11 is you restructure the company, it survives and moves forward. Chapter 7 is the trucks pull up and take the pieces and it goes away. Quick comment about multiples, and then I'll be glad to answer questions, and hopefully, Brian, we're sort of back on time. This is an eye chart, and it'll be in the slide deck, you'll see, but this comment that multiples can look odd, right? Everybody knows how to talk about multiples. 6 multiple is a okay multiple, an 8 multiple is better, a 12 multiple is a home run. Okay, we know multiples, right? That's what we use in this industry. Multiples are going to look really weird over the next 12 months. And it's just it's not algebra, it's arithmetic, right? A lot of people on this phone, on this Zoom, are a lot better than me at sophisticated math. This is simple math, but the example is here. So if in 2019, I had a company that, call it franchise value, had a total value of $432 million, and it had EBITDA of $29 million this year, last year. Its multiple was 15 or 14, depending on which year you picked. If that company lost 33% of its value, so it's now going to sell for $290 million, and EBITDA went down 57%, its multiple goes up. Let me say that again. The value goes down 33%, so you just lost 33% of the value of your company. Your EBITDA went down by more than half, and your multiple goes screaming up. There's going to be a lot of that stuff in the newspaper. Okay, you're going to say, wait a second, somebody traded for 23 times EBITDA? Well, if your EBITDA is precipitously declining, the math gets weird and it looks like a high multiple. Don't be fooled by silly math. Okay.
Bill, got a question. I got 2 questions. You can go back a slide. If
Sure.
You're planning to sell and could reduce your company's indirect expenses, assume 20% of the revenue, by 20%, how would that impact EBITDA?
So cutting costs is a great way to survive through the downturn. And to any seller that's in a sector of the market where you're going to continue to see month on month weak revenue and no improvement in those revenues month to month, then you shouldn't be a seller. Because if you just wait till the other end of this, values will start coming back. That could be as soon as 24 months. I mean, you got to get into the math about your programs and your customers and all the rest of it. But the cutting expense to me is not a, how do I create value so I can sell for a higher price next month? The cutting expense is, how do I guarantee my survival so that I am around in whatever it's going to be, 2 years, 3 years, whenever, when the market comes screaming back and I'm back to producing the same level of profitability I had in 2019. That to me is the great benefit of cutting costs.
Great. And another question for those that don't know, what is EBITDA?
Sorry, it's just a proxy for something between earnings and cash flow. It's a proxy that we investment banker geeks use. Sometimes net profit is rather ephemeral and it doesn't really relate to money. It's more of an accounting term. And so instead of using net income, we use EBITDA, which is technically earnings before interest, taxes, depreciation, and amortization. It gets closer to the cash that went in the bank at the end of the year. Closer to it. It's not it.
Okay, great. Thanks, Bill. I think that's it for what we have for questions.
I'll give a takeaway, Brian.
Yes, please.
My takeaway is that the aftermarket is going to start to have M&A activity, and that's good and it's healthy, and that's what we do for a living. So we're looking forward to it. The OEM supply chain is going to have a tough go right now. I'm a firm believer in the longevity, health, and strength of the commercial aviation industry. And if you're in the production cycle or supply chain, hunker down. It's not going to last all that long, but hunker down, preserve your cash, be at least break even. And then if you want to sell someday, you won't have to wait that long.
Great. Bill, great presentation. Thank you so much. Thank you for joining us today and sharing your knowledge and insights. You're getting thumbs up over the chat left and right now for your information. So thanks for being here. Thanks for being part of this and help make this event possible.
Thank you, bro.
if you have any questions about M&A, valuations, things like that, Bill would be more than happy to speak with you and share his insights further. So thanks again, Bill.